Why should anyone invest their money? First, let's talk about inflation. It's the silent thief that eats away at your savings. If you're keeping all your money in cash or a low-interest savings account, guess what? You are losing purchasing power every single year. Many investments have outpaced inflation significantly, especially businesses and real estate. Over the past 30 years, the S&P 500 delivered an average annual rate of return of around 10%, or about 7% after adjusting for inflation, while being more accessible and liquid than alternatives. Let's break it down. Here's how different investments have performed over the last 30 years. The NASDAQ, an index fund tracking technology stocks. It has very high compounded growth of about 14%, 10% after inflation, but much more volatile with higher highs and lower lows than the S&P 500. U.S. equities, the S&P 500, the largest 500 companies in the U.S., has compounded at a rate of about 10% before inflation, 6.5% after. Gold completely depends on the period discussed. 4 to 6% is the common expectation for gold, but it has long periods of stagnation, periods of increased volatility, and when inflation is high, it tends to outperform and even keep up with equities, which it has over the past 25 years. Bonds. Again, this depends on the period, but about 4 to 6% depending on circumstances. Significantly low over the past decade. And corporate bonds tend to yield more than government bonds, but at a higher risk. Imagine whether any given company is more likely to default on their debt than the US government, and you'll know why corporate bonds are issued at a higher yield in order to entice someone to buy them. I'll go over bonds more in depth in another video. Annuities tend to have a touch lower yield than bonds, but they have guarantees from the issuer. CDs, safer still, and lower yields. High interest savings are typically your 1 to 2% range, but some banks offer higher rates by a percentage or two as an incentive to bank with their institution. Banks, of course, want your money, so they can invest it in higher yielding bonds and loan some of it out at even higher rates. And of course, cash, 0% to losing value to inflation. Unless, of course, you have an immediate need for cash, it is obvious that these investments are all preferable. That's why they exist. In fact, here's the long-term chart showing how each compounds over time compared to cash. Now, let's also take a look at the last 30 years of real estate ownership as a comparison. Higher transaction costs and down payments, but outstanding returns depending on the local real estate market. Real estate is its own game. A building is not nearly as liquid or accessible as a stock. It has upfront costs, ongoing costs, maintenance, and either tenants or even renovation costs if you're flipping it, transaction fees of 5% plus, negotiations on price and everything else in the universe. But lenders allow leverage in the form of a mortgage, which enhances returns over time. A viable alternative from a compounding standpoint, depending on the conditions, but the liquidity and ease of investing in stocks makes them highly attractive in comparison. If you like the real estate game, it has certainly been rewarding, but equities provide similar, if not better, long-term returns for a lot less work. I will note that equity REITs, companies who own and operate income-producing retail properties, can also be purchased, and depending on the time period and type of properties managed, have returned between 7% and 14% compounded, making them great additions to a diversified portfolio, as always, depending on your individual goals and risk tolerance. Now, there is another consideration. Many people like to invest in gold and other hard assets in order to diversify against some sort of financial collapse or catastrophe. If that's you, that's great, so be it. Gold tends to be uncorrelated with equities, a safe haven during volatility, and a hedge against inflation. But we want to invest in our most likely vision for the future, a future which includes inflation and businesses continuing to provide great compounded annual returns. So why invest in stocks? Compared to cash, these investments all absolutely crush the enemy, inflation. And stocks offer a cheap and easy, understandable way to do so.